Alright, so second video here, and we're going to talk about the various phases that the market goes through, and this is crucial to understanding how smart money operates, and they operate within these phases, so they behave differently depending on what phase they're in at the time. So we need to have an understanding of these phases before we go any further into analyzing the candles and volume and all that. So let me switch the chart. All right. So here's the primary market phases as described by Richard Wyckoff many years ago, and it still holds true. I'll go through each one and talk about here. Now, there's basically a cycle that's going on. Now, in this chart we're looking at a very clean, the primary phases in a very clean market. Of course, there's variables, but you need to know the basic layout, the basic phases, before you could get into further detail and read any variations on it. So let's look at this as a cycle. So you have a down move before this, even an accumulation again, and an up move. So you can see how it could continue as a cycle. So we're talking about accumulation here to start. The characteristics of each phase we'll start with. So the characteristics of accumulation is you're coming down from a markdown phase. Accumulation will begin on high volume. So the first thing you're looking at is down bars going into new low price areas, up the downtrend, and that hitting some high volume, what we call stopping volume, and that's going to be confirmed if the low of the candle that's hitting that high volume is not broken. There's no lower low made on the next candle. And I like to look at the 1 hour, by the way. I'm looking at the 1 hour chart to determine these phases. So accumulation, most of the time, maybe 90% of the time, it's going to start out with a widespread high volume down bar during a down move. And the next candle to follow that on the 1 hour, would be bullish. An inside close, engulf it. As long as there's no continuation to a new low on that close, there may be a pin below it, but no close below. And so that is 90% of the time, somewhere about there, is how you're going to start the accumulation phase. So that's stopping volume and with the bullish reaction on the next candle. But then you may or may not go through accumulation for whatever period of time that may last. It could last for an entire session. It could last for a couple hours. So you have a range, basically a range in price after that down move is stopped. And the characteristics to also confirm that this is still accumulation, and that's accumulating buy orders. And we were talking about that in the last video, buying into down moves. So you would continue to see that sort of activity, that lower prices, and they may vary, of course, in the real world, but the lower prices, the down moves being stopped on increased volume with a bullish reaction. So that's the characteristics you'd be seeing here to confirm throughout a range that you're in accumulation phase. So what we're talking about before, those down moves being bought up, lower prices bringing demand. One characteristic you'll commonly see in accumulation is if, let's say you have that low established and you have finally a break below there, and you have a high volume pin, and then the next candle also is bullish. That's called a spring, and that again would be telling you you're in accumulation phase, and that usually marks the end of accumulation phase if you happen to see that. Sort of a fake breakout. Again, that's keeping in line with the idea of buy low, sell high, buy into down moves. And buy in such a way that has not marked up price yet. So by the time you get to the end of accumulation phase, smart money has built up long positions at the lowest price that they can get, without marking price up yet, without showing that they've done that, unless you're analyzing the market this way. So there'll come a point where there's no more sell pressure. Let's say coming off of this down move that was coming into there, all the traders that were going to go short, expecting a continuation and that the trend was going to be their friend, eventually you got to a point where there's really not many left. So the smart money looking for those down moves to buy into, reaches a point where there's no more sell pressure and everybody's locked in the wrong direction. So that is when we start to move up. So it's a lack of supply. Supply is selling. Demand is buying. So it's a lack of supply that's going to ultimately, allow this demand, force this demand to come through if there's no more selling. So that comes down to something we'll talk about later. Looking for not only the demand and the accumulation, but the lack of supply to give you that imbalance where you now have proven demand, a proven lack of supply, and that's where you can expect the accumulation to go into markup phase. So it's all logical. So we go through these phases, and so here you would have a trending move. Here's the cause for the trending move that you could foresee. And, often you'll have pullbacks, you may have a channel, you have a regular trending move happen. And reaccumulation is basically a trade that I take very often, as far as reaccumulation is when it pulls back to a 5618 area and again hits that stopping volume and does that same type of activity. The reaccumulation tends to not last as long as the initial accumulation. The reaccumulation could be shorter, could be one pin off, but sometimes, the point is to see the higher volume to stop those down moves, and often at a 5618 fib zone, they move up. Another opportunity to get in long during a markup would be on a no supply, and we'll talk about that. We'll also talk about how to handle trading this area and where to get long in anticipation of that up move. And then eventually you run into distribution, which is basically accumulation in reverse. You'll run into high volume. May go into a range. You want to see the higher volume points at the top. You may get a fake breakout above. And you want to see the lower volume points at the bottom. Showing that there's more sell activity selling into the up moves than there would be buy activity. So there'll be more supply than demand. We can call this supply coming in. And, as smart money has marked up price and it's taking profit and then going short, it hasn't shown itself in price, and again, it still appears to be an uptrend. So it goes through these cycles. Now, what else do I want to get into in this video? I think I'll show a quick version of this on the chart. We've had markup reaccumulation repeatedly here in the last couple of weeks. So here's our down move, markdown. We run into accumulation. In this case, it wasn't a very long lasting accumulation, but again, this widespread bar on high volume with that bullish reaction starts to confirm what's going on in this area. If it wasn't too clear beforehand, once we get into the major trading of this day, it becomes very clear. And that's also a good example of that fake breakout that I was talking about. So that high volume, widespread down bar, bullish reaction. So that was accumulation and buying after a markdown. We go into a markup phase, and you can see again the characteristics here on a pullback. We're talking about reaccumulation after a markup. You see that same widespread high volume. There's a doji, mentioned that. Why that happens, buying into the down moves and matching those sell orders with buy orders before market price up, and then continuation, the markup continues. So there, you can see it going through that cycle. Something to point out here, you may be saying, well, what about that high volume here? The reaction to high volume points is what confirms them. So in this case, that high volume down bar, if it was another bearish bar, candle, then that would not confirm that this is stopping volume. So we need that to confirm. In this case, if we had a bearish reaction, that would be showing weakness in this up move, and maybe that this markup is failing. But you can see the direction is bullish. And so the markup goes, it reaccumulates. Another markup again, widespread, high volume down bars. You got on Friday here. Continuation. And the other thing I want to show about these is, like I was just saying, there is how common the fibs come into play. If I draw the first move up, is at 50, bounce again, 50 to 618 zone. See that happen again? If you take from the low of that, reaccumulation. So when it starts to pull back, you would have that again, 50 to 618. Looking for that long. In this case, didn't come that low, but this is actually the example in the first video. I think there's another 50 to 618, so it's been an easy couple of weeks. There's another one. Again, showed a high volume, bullish reaction. There's an example where reaccumulation didn't take too long. Although you can say it started here already. Not the healthiest markdown and not the healthiest down move there. That wide spread. At the 50 fib, seeing that demand come in. That was the example we used. So you can see how common that setup is during a strong trend. Markup reaccumulation. So we'll go through these phases. You hit, again, we're talking about the start of the accumulation phase, the start of the distribution phase. And that is possibly happening here. This was Friday towards the last few hours of the session. And you can see a widespread up bar with a bearish reaction. See, that's the opposite of what we're talking about. On the bottoms, looking for the widespread down with the bullish, high volume. So this is the first line of distribution. So once I saw this candle, widespread, pin on top, high volume, and then I saw this reaction, bearish, I said, that's it. There's no more looking for longs anymore. This is possibly a distribution phase. And of course, I have until Monday, and getting into London session, I would have to worry about getting into a trade, and I can see if this continues to show that this is distribution phase, and I'd be for a short. But one of the common things that it may do is come back to test this level. Oh, I actually pretty much did that. Previous resistance becomes support. I could possibly come and test this level if there's going to be real sell pressure coming in, but that has confirmed weakness there. Well, you saw that candle pattern, and you can see the next two candles were bearish. As much as, as big as that up move was, caught a lot of traders who short long, and the weakness was shown, though, selling to that up move. So we call that supply coming in, and seeing that could be the start of a distribution phase. And again, we'll get more into entries and using the 5-minute chart for entries. So this video was to cover the phases, and I think we did that pretty well. So we'll move on. Hey guys, it's Pete. Wanted to make this series of videos to go over my trading method, which is VSA, volume spread analysis. Sort of teachings of Richard Wyckoff. And along with that, Fibonacci 50 to 6.8 levels, and really just simple support resistance and trend lines, channels. So the basis here is VSA, volume spread analysis. That is referred to as tracking the actions of smart money, the big money, money that moves the market, knowing how they operate and watching what they do, using volume and candles. So this first video, and then we're talking about really down to the root cause of price movement. We're talking about the money that moves the market and understanding how they work and trading along with them. So this is really truly getting down to the cause of price movement, supply and demand. So to start at the very beginning, these volume bars represent tick activity here, trading spot forex. So the increases and decreases are telling you the amount of activity per bar, the amount of tick change. So we're talking about, when I say tick activity, price ticks. So the more tick activity, price ticks there were per bar, the higher the volume is going to be. So you can see, for example, in a bar like this, which is a candle like this, which is very small, relatively small, and you can see that was the highest volume of the day there. So we know that during this little candle here, there was a lot of tick activity. Price was changing a lot as compared to this candle's about the same size, and you can see a much lower volume. So, price wasn't changing as often. So that's what it represents. Question is, why do we care? What does it mean? It's telling us when the market is more or less active. We could say that. So there's more orders coming in. Obviously, end of New York session, before Asia session starts, you can see the lack of activity, a little increase, Asia session begins. You have a little lull before, London Open. Here's London Open and New York session. So you can see the activity fluctuations. And we're talking about order flow. We're talking about, large orders and really these large amounts of, volume and activity are created by big money, smart money, and they tend to operate basically the same way. We can see what they're doing, knowing how they operate. So, a basic principle that they operate off of is buy low, sell high, buying into down moves, selling into up moves. That's when they put a lot of their position, most of their position on, when they're accumulating position. So, an example of that would be we have a markup here. We have a pullback and we have reaccumulation. What happens here is you can see after a nice trending move, as price pulls back, that it hits a point where the volume increased significantly as it attempted to make these new lows, and it was rejected. So what's happening here is you have basically the herd selling, most traders selling, and this is where professional money, the money that moves the market, decided to start buying. So you have an increase in activity, and the down move is not continuing. So that's the principle there. If you're trending downwards, you see that increase in volume. What's happening is the professionals are buying, and they're using the selling pressure that's currently in the market creating this move to put in buy orders without marking price up against them, because they need to get filled with some large orders. And if they were to just throw those orders in at any random time, price would mark up to fill them. They like to accumulate these long positions. So it's buying into down moves, and it remains hidden as far as price, that these large buy orders, come in here. But with the tick activity, we know that as the market is coming down, in response, their buy orders are coming in. So it ends up with these pins, these dojis, and this increased tick activity as prices coming down, getting bought up, coming down, getting bought up. So we see the footprints of the professionals there buying. So subsequently, right after that, we had an up move. We came into Asia session, it was a retrace, and you can see that level, held as a level of demand. And again, they acted the same way, coming into that level. And then finally, London, New York session, that's a nice up move. So, that's a good way, a good first example there to explain how they operate when they're in accumulation phase, in this case. And really the increase in volume, and along with the candles there, revealing, that they were buying. So, that's basically what I wanted to cover in this first video. It's just, what these volume bars represent. So it's tick, activity increases. That represents more orders coming into the market. And if there's that amount of orders in a concentrated amount of time, well, this is smart money activity, and knowing how they operate, the principles that they operate off of, which I'll get into more in the next videos, then we can see what they're doing, where they're positioning themselves, and what direction they expect price to go, building a cause for the move. And of course, we trade along with that, in anticipation of that move. So, again, really getting down to the core of what moves price. So I think that covers it for this first video on what I wanted to cover there. So I'll end it here and I'll go on to the next.